2022 was really a challenging year. There are a lot of events to follow in 2022. Cryptocurrencies had a really challenging year. High and rising interest rates, high and rising inflation, slowing global economy, supply chain recovering, and just a very strong consumer and labor market continuing to spend and really put the foot on the gas from a demand standpoint. One of the big sort of market moving headlines again was related to interest rates and rates going up and how that's going to affect certain types of investments. Notably, when you look at a lot of the stocks that did really well during the pandemic, a lot of the stay-at-home pandemic darling stocks were growth stocks. A lot of them were software related and they were trading at really high multiples. So when rates go up, obviously the discount rate goes up, the value is going to go down, and so a lot of these stocks were trading at valuations that made no sense. They were very similar to dot-com era valuations. We had a bit of a repricing as far as growth stocks are concerned. In many instances, the drawdown was worse than what we saw in the dot-com boom and bust. So a lot of the high flyers from 2020, 2021 were down 60, 70, 80% this year. Fortunately, they were considered small cap growth stocks. They weren't widely owned, so as far as an overall portfolio impact, it was pretty minimal, but certainly for those who held the stocks, it was painful. In the first quarter and the second quarter of this year, we actually saw an economic contraction, albeit a small one. That isn't technically the definition of a recession, but that's how a lot of people will baseline, expecting a recession. To this day, we're not technically in a recession. Fixed income was really the story of the year, being challenged by rising interest rates. Investment grade bonds delivered the worst annual return in modern history. Put it in perspective, we've never had a year in the last 150 years where stocks and bonds both declined by more than 10%. So really the story in 2022 was you had the low-risk part of the portfolio, being bonds, not providing any downside protection to the higher risk or equities part of the portfolio. And that was nearly entirely driven by the fact that the Fed had to raise interest rates to combat inflation. The price of a bond is impacted by a change in interest rates, especially for a fixed-rate bond. So as rates go up, the value of the bonds go down. Looking at a style perspective, value stocks did considerably better than growth, which bucked the trend, say, over the last 10 years, where mega cap growth stocks had been compounding at more than double the rate of return that you saw from value stocks. And again, I think a big part of that was just due to very aggressive Fed raising interest rates, perhaps inducing a recession, tightening to that point. Thank you for watching. If you have any feedback, please let us know. My name is Kevin McCulley, again, Senior Advisor with Private Capital Management. We'll see you next quarter.